Nvidia's stock price has absolutely exploded in the last 5 years, rising from a low of $3.72 per share all the way up to $131 per share. Understandably, some investors feel like they missed out on Nvidia stock, like it's too late to buy Nvidia stock, and are looking for another excellent AI investment. Lucky for you, I've got just that investment in this video here. So let's take a look at what AI stock I think investors can buy if they feel like they missed out on Nvidia stock.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Alright, the AI stock I'm recommending in this video to those who feel like they missed out on Nvidia is ServiceNow. ServiceNow CEO said that as leaders seek significant productivity improvements, ServiceNow has a first mover advantage with years of investment in AI technology and talent. Our Gen AI offerings are the fastest selling in the company's history, and we are humbled by the trust by the customers investing in our platform. Now, I highlighted earlier that Nvidia stock has absolutely exploded, and that doesn't mean that I still don't think Nvidia stock is an excellent investment. Still, if you feel like it's too late for Nvidia stock and you're looking for something different, ServiceNow offers a great opportunity. The company over the years has done an excellent job growing its revenue, as you can see in this chart here. Trailing 12-month revenue has jumped up to $9.478 billion, up from a little less than $2.5 billion in 2019. And that increase in revenue has had the impact of increasing cash flow from operations as well. The company's cash flow from operations in the orange has jumped to $3.837 billion, up from a little less than $1 billion in 2019. I like to see companies increasing their profitability and their cash flow from operations as revenue is increasing. I don't like to see companies that are just increasing revenue at the expense of profitability and cash flow. ServiceNow has done both, where it's increasing revenue and increasing cash flow from operations simultaneously. Additionally, if you look at the company's remaining performance obligations, which I have highlighted here, you'll notice that it's still increasing strongly. In fact, its remaining performance obligations are increasing faster than current remaining performance obligations. The difference between the two is that RPO suggests revenue that's going to come after 12 months, whereas current RPO is revenue that's going to come in the next 12 months. Remember, remaining performance obligations are contracts that ServiceNow has signed with customers and will eventually turn into revenue. So RPO and current RPO increasing year over year is a good sign for revenue growth for ServiceNow. And you'll notice that its current remaining performance obligations at $8.45 billion was up by 21% year over year in the most recent quarter, whereas its remaining performance obligations of $17.7 billion was up by 26% year over year in the most recent quarter. If you compare that with its recent quarterly revenue of $2.6 billion, you'll notice that the company's $26 billion in remaining performance obligations is about 10 quarters worth at the most recent pace. So you have visibility into the company's future with its revenue because of these remaining performance obligations. So investors can be reasonably confident that ServiceNow will continue to experience revenue growth robustly over at least the next 10 quarters and likely even beyond that. But you have the remaining performance obligations contracts it's already signed for the next 12 to 24 months. So that's great news if you're an investor that likes to have visibility in a company's revenue prospects. Another metric I really like from ServiceNow is its improvement in return on invested capital, up to 22.48% in the most recent period. That's up from less than 6% in early 2022. Remember, return on invested capital measures how good a company is at taking money from investors and investing it into the business, creating products and services that generate profitability. So capital is what comes from investors, and then returns is what comes from the company. So taking capital from investors and generating profits. That's the name of the game here. And the better you are at that task, the better returns you'll give your shareholders. ServiceNow is getting better and better in this metric. As you'll notice here, over the last 3 years, it's improved meaningfully, more than 4x where it was in 2021, late 2021, and now up to 22.48%. And given the significant improvements the company is experiencing in demand for its generative AI products, it's likely that it will continue improving this metric. Overall demand from the marketplace for artificial intelligence solutions to productivity enhancements is growing faster and faster. As the cost of labor is increasing, demand for these solutions is increasing more quickly. So the company is in the right place at the right time with a business model that's proven to be effective. That's one of the reasons why I've liked ServiceNow stock, and I'm recommending it here in this video. Lastly, ServiceNow is trading at a relatively fair valuation at a forward PE of 45.74. You'll notice that going back all the way to late 2021, this is about where this forward PE ratio has trended. It has been lower in some moments in early 2023, and it has been higher in other moments before 2022. So this average valuation here, the forward PE of 45.74, I would say is fairly valued for ServiceNow. I wouldn't call it cheap. I also wouldn't call it expensive when you compare it to its prospects in terms of revenue growth and cash flow from operation improvement. So it's justified to have this premium valuation because of the premium operation capability of the business. So when I see a business like this, I'm willing to pay a higher price for it because it's delivering better results than most businesses in the stock market today, especially because it's operating in the AI category, which is expected to increase by more than $1 trillion in total annual spending worldwide in the next decade. So I like the company, I like the market it operates in, I like the profitability improvements and the metrics in the business model, and I like its valuation as well in combination with all of those things. So if you feel like it's too late for Nvidia stock, which I will remind you, I don't think that's the case. I think Nvidia stock is still a buy. But if you feel like it's too late, if you feel like you missed out, then I think ServiceNow is another excellent AI stock you can buy today and hold for the next 5, 10, 15 years to capitalize on the growing effectiveness of artificial intelligence. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.